We now turn to the exciting world of bonds and equities. Bonds, also known as fixed income. Bonds have three attributes. To define a bond, remember a bond is simply an IOU. You want to know the amount of the loan, that's the par value. You want to know when you're going to get paid back, that's the maturity. And you want to know the interest rate that you're going to get for giving up those bonds. Most bonds come with a par value of $1,000, and most bonds pay their interest twice a year. So if you have a 10% bond, you get paid 5% every 6 months. There's multiple types of bonds. Important bonds to know are certainly government bonds. We have U.S. Treasury bonds. You'll hear a lot in the news about the 10-year notes, the 10-year bond. But it's also important to look out at the 30-year bonds. But the 10-year one is the one that people most often talk about in the news. Those are government bonds. We have corporate bonds. Corporate bonds come in two flavors. Debentures, which are just a promise to pay back, and secured, which means there's collateral. Some sort of asset is held, and if the bonds go into default, the company goes into default, bondholders get that claim on that asset. There are also municipal bonds. Municipal bonds are state and local governments. They come in two types. General obligation bonds. Again, a promise to pay. And what happens is the state or local municipality raises taxes to pay the interest. And they come in revenue bonds, where there's some sort of revenue coming from something like the tolls in New Jersey, tolls on bridges, tolls on the parkway, that go toward producing revenue for the bonds. Municipalities like revenue bonds because they pay a lower rate of interest, because they're less risky. So, what type of risks do bonds have? Come in two flavors, sort of. One is default risk. Maybe the business or the municipality can't pay the bondholders their interest. That means they'd be going into default. Second type of risk is interest rate risk. As interest rates fluctuate, so does the price of a bond. Interest rates go up, price of a bond goes down, and vice versa. Then there's also inflation risk. If inflation goes up, the value of the bonds out in the future is worth less, so you're willing to pay less. So if inflation goes up, that means the price of the bond will go down. I'm not willing to pay as much for those payments, interest in the par value way out there in the future. If inflation drops, well, now those things are worth more, and the price of the bond will go up. How do we get money back from bonds? We've taken those risks. Well, we get a yield. A yield is simply the payment divided by the interest payment divided by the price. That interest payment doesn't change, so that's a fixed number. But the price can go up or down, which makes the yield go up or down. It's just exactly what we've been talking about. So if the payment stays the same and the price goes down, that means the yield goes up. And if the price goes up, because it's in the denominator, the yield goes down. Now there's another term known as yield to maturity. Yield to maturity is really the present value of the future cash flows, expressed as a rate. I want to know that because what that incorporates is the time value of money and that par value payment at the end of the maturity. So those are the yields. Those are based upon the interest and the payments that I get. But we may sell our bond early, before maturity. If we sell it and make a profit, we have a capital gain. If we sell it and lose money, we have a capital loss. Now, the bond can be above or below par when we sell it. The price will go above par value if interest rates go down. If the current rate is lower than the rate of the bond, that means those payments are worth more, so the price goes up. And similarly in reverse. If the interest rates go above the par value, above the coupon interest rate of the bond, if the interest rates go above that, then I'm not willing to pay as much, so the price goes below par value. And we've also talked about the yield curve. The yield curve shows the different yield as a function of maturity. And typically we have an upward sloping yield curve. Let's turn to equities. We have two types of equities, common stock and preferred stock. When we look at common stock, we want to look at how much that stock is going to grow. We typically buy it so that the stock price goes up. Well, we want to know the growth factor of the stock, and that is the return on equity, the amount of profits that are being generated for the owners, times the percent that those profits are being plowed back into the business. That gives us an idea of how much we expect the company to grow. We then can calculate the value of that stock by the equation shown here. The price is equal to the next dividend divided by our required rate of return minus the growth rate. The expected rate of return on this stock that we're going to get will be the dividend divided by the price plus the growth rate. Well, the dividend divided by the price is just what we call the yield. The dividend yield, the book says, or we just call the yield on stocks. The dividend divided by the price is the yield. So if a stock is paying 4% dividends based upon its price, plus we expect a growth rate of 2%, and 4% plus 2% gives us an expected rate of return of 6%. Preferred stock. Remember, preferred stock is just a perpetuity. It pays a required dividend, a fixed required dividend, forever. So partly it's like a bond. Fixed income is partly like a stock in terms of it doesn't ever have to be repaid. The expected rate of return on that is simply the dividend divided by the price. It's a perpetuity. Where do we get our money from stocks? Well, first of all, the risk for stocks is the performance of the company. So if we take risk, we want returns. And they come in two flavors, dividends and capital gains. Very similar to bonds where you get interest. For capital gains, here you get dividends or capital gains. Now, some companies pay no dividends. That doesn't mean they're not doing well. What are they doing with the money? They're plowing it back into the business. Many returns from stocks come from capital gains. But dividends are also an important factor. What you want is really depending upon your investment objective. Are you looking for current income? Are you looking for long-term growth or something in between? Companies that pay no dividends are more likely to grow because they're reinvesting their money. Companies that pay dividends are less likely to grow, but you get your money early on. All right, that was a quick review of the comments. Again, you might have the slides. You may want to go back and look at the other slides and videos from the prior weeks. But next I'll give you a little bit of an overview and review of using Excel with these concepts.